We've been talking about do's and don'ts about the stock market for a little while now, and you might think, even if you follow all the steps, how do you create the perfect stock portfolio? Well, the short answer is you can't. The best you can do is focus on creating an optimal portfolio, and here are the factors you need to consider and keep in mind before you start working on it. Time horizon. Let's say you enter the market with a mindset that you have to invest for 2 years. So you might decide to invest in the sector that is trending, which can be the finance sector or even the metal sector, which is growing at a considerable rate. But longer time periods would require stocks with a sustainable and growing business. You might want to invest in the sector which focuses on clean energy and divert your attention away from sectors which increase pollution because you don't want to be in losses 10 or 20 years from now. Here's an example. Tesla continuously works on developing new ways of manufacturing new cars, which won't harm the environment. So you might want to consider the impact of their constant evolution of technology, which will save the environment and give you profits at the same time in the long run. Risk tolerance. It all depends on which type of stock you plan to buy. Some stocks can be volatile, while others might be defensive, such as FMCG stocks. Diversification. The magic of diversification is that you can do wonders and save from heavy losses, thus maintaining your portfolio. We suggest you refer to the last section when we talked about not putting all your eggs in one basket. Financial constraints. What's the amount of capital that you currently own? What are the expenses you currently incur? What is your risk appetite? What's the number of dependents and the number of earnings members in your family? Well, you should consider all these questions and answer them properly, as well as consider the consequences before starting to make your portfolio and deciding the kind of investor you want to be. Financial needs and goals. Remember why you're entering the market to invest. It's because you want to have enough money for retirement, or maybe you want to buy a car or a house, or maybe you simply want to live off the dividends. There can be many reasons why you've decided to invest, and it all depends on your needs and goals. Before you go about deciding the kind of stocks for your portfolio, you need to look deeper and find out what exactly your motivation is to invest. You'll make better decisions and only buy those kinds of stocks that align with your interests. Let's consider an example here. Say you have $100 for the sake of the course. I'm sure you have more to invest. You'll invest that $100 differently depending on the type of investor you are. For simplification purposes, we have 5 portfolios depending on your willingness and capacity to take risks. Conservative portfolio, moderately conservative portfolio, moderately aggressive portfolio, aggressive portfolio, very aggressive portfolio. Now let's look into how people might spend that $100 in question according to their portfolio. As we can see in Figure 1, people with different portfolios have different mindsets and different goals according to their investments. Let's consider the case of a person who has a conservative portfolio. We can see that this person has invested 70% of the wealth in stocks where he or she is trying to minimize risk and not earning very high profits, but is securing a livelihood, perhaps for retirement. On the other hand, this person isn't trying to invest heavily in growth stocks, small cap or mid cap stocks where there's growth potential, but higher risk as well. And that might not be well suited according to this person's risk appetite. Lastly, as we can see, the person has only invested 15% of the wealth in a savings account, FD and gold, because while there's not a major risk in this area, there aren't adequate returns either, which might reduce the motivation of a person to reduce their investments in cash and cash equivalents. On the other hand, we have a person who has a very aggressive portfolio, or VAP, in which we can see that he or she has pledged 80% of wealth in growth stocks. Now, this carries higher risk and higher returns as well. One might say that this is all bull. This person is willing to take a high risk to receive higher profits. As a sense of security, this person also diversified the portfolio by investing in blue chip stocks and the ETF index with 20% of wealth, which might not be very high. However, it is still better than nothing, and he or she will still get decent returns as well as dividends. But as we can see, that since he or she is only interested in earning profits, even if that means taking a high risk, that would explain why there's no interest in investing in cash and cash equivalents. We can clearly see in the figure that as we move left to right from a conservative portfolio toward an aggressive portfolio, the investor will invest a lesser amount in cash and cash equivalents and blue chip stocks, and will invest a higher amount in growth stocks and in small cap and mid cap stocks. So before we move on to the next topic, we have a small task for you in which you have to look into the 5 portfolios that I just mentioned above and try to classify yourself in one or more of the 5 categories. Choosing which stocks to trade. Okay, welcome back. I hope you've completed the small task. Now we'll talk about which stocks you should choose to trade. There are some general rules you need to look into before picking up stocks to trade. Of course, after understanding the underlying concept, you can now develop and follow a strategy of your own. But having 1 or 2 of these strategies in your arsenal is a good start, which will give you the necessary push you need to start trading. Observing the market direction is a good strategy, even for people who have been trading for a long time. While trading, traders follow a rule that suggests that if a stock rises in value under the current market condition, it will continue to rise if market parameters remain unchanged. As the popular saying goes, the trend is your friend. You should try to find stocks to buy or sell according to the broad market or the index trend, as that improves your chances of winning. You can find the best performing stocks through various sources, such as browsing through company news, chasing the top stocks in the exchange, or following stock indices. Next in our list of strategies is stock screening. Swing traders look for potential buy or sell signals to spot opportunities. They combine fundamental data with technical analysis to identify sectors and stocks which outperform indexes for the better part of a trading period. They shift through stocks to park their expectations with stocks that reflect volatility with volume. Now, this process is called screening stocks, and it involves the following. The first thing you need to consider is liquidity. Liquidity simply refers to the ease with which an asset or security can be converted into ready cash without affecting its market price. The daily traded volume of a stock is an indication of demand in the market. A stock with a high daily trading volume is considered liquid enough for swing trading. Highly traded stocks exhibit lower risk exposure. If you enter a thinly traded stock, which sometimes moves circuit to circuit, it might screw up your trade plan, as an exit isn't easy from such an illiquid stock. Thinly traded stocks will not let you exit at the market price, as that has a low demand and supply, which brings in a lot of slippage. To reduce such risk, it's best if you stick with stocks that have a minimum average daily dollar volume of $20 million to $25 million over a period of 20 or 30 days. In fact, the more the better. Institutions tend to get more involved in a stock with daily dollar volume in the hundreds of millions or more. Let's say that there are 2 grocery stores in front of your house. What do you do to consider before buying anything from the store? Price or the quality of the goods? Quality, right? Because price means nothing if it means compromising quality along with it. In simple words, you assess the performance of the 2 stores. That's the way to go in the stock market as well. Know your numbers, know the reports, and do a thorough and comprehensive analysis of stocks against the performance of other stocks from the same sector. Your goal should be to find the strongest stocks in that sector which have outperformed sector indices. Consider the effects of correlation and volatility. Let's say you see a stock that moves outside market trends. Now, that may look attractive, right? But if you're a swing trader, you might want to stay clear of such stocks. Your aim should be to avoid unpredictable and inconsistent stocks which move with major market indices. If you're curious about the performance of the stock and want to find out why it's behaving the way it is, the best thing you can do for yourself is to dig deeper into the past of that said stock and analyze its historical performance. Lastly, you must be aware of the repetitive patterns which certain stocks show in the market. It won't be surprising if you, as a swing trader, look for such stocks and might start considering a repetitive trend as a reliable strategy. But if you ask an experienced trader, they'll tell you the same thing that we're telling you. You should wait for the stock to break the trading range to plan entry. And while on it, you'll have several opportunities to make small profit trading toward the trend. If you are into swing trading stocks, we're going to discuss a few strategies which will help you plan your trades better, and you can start identifying relevant trading opportunities. So, with the help of these strategies, you can manage your trades from start to finish, and if you're not a swing trader, you can skip to the next section. Okay then, without any further delay, let's dive into these techniques which will help you find possible trade entry points for the stocks in which you are interested. Fibonacci retracement. First up on our list is the Fibonacci retracement tool. Now, we use this tool to connect a trend from the lowest point to the highest point for a certain period, so we get relevant levels for the retracement. If the stock is in a downward trend, then we can also put it to use in an opposite way as well. Let's consider the example of Facebook. Stocks often tend to retrace a certain percentage within a trend before reversing again. In the above stock chart, when we connect the lowest point to the highest point, we get a classic Fibonacci ratio, 23.6%, then 38.2%, and 61.8%, revealing potential reversal levels. When the price in an uptrend retraces to 61.8% from the highest point, the horizontal line at 61.8 acts as a support level, which is a good position for buying opportunities to enter the market. Then you can wait until the price rises and the ratio hits the 23.6% Fibonacci line, which acts as a resistance level at which you can exit your position for a profit. Channel trading. You can see a channel trading pattern when a stock displays a strong trend and consolidates around a parallel channel. As visible in the figure, we've plotted a channel pattern between the price of $142 and $158. When we see a breakout outside the channel, we would consider opening a buy position when the price bounces up off the top line of the channel. When you use the channel trading tool to swing trade stocks, it's important that you trade within the trend. In the above example, when the price is in an uptrend, you would only look for buy options, unless the price breaks out of the channel, moving lower and indicating a reversal and the beginning of a downtrend. 10 and 20-day SMA. Next up on our list is moving averages, or simple moving averages, SMA. A 10-day SMA takes the average of the closing price of a stock of the last 10 days, and as the days pass by, the average will as well start adjusting itself. If today is the 30th, and assuming that the market is open on Saturday and Sunday as well, the tool will take an average of the closing price of the stock from the 20th up until today. 20-day SMA works in a similar way, except the average of 20 days is taken of the closing stock price. Each average is connected to the next to create a line or curve on the chart, which we call a simple moving average. This line helps us determine the entry or exit options for a stock. Let's again consider the example of Facebook in the above stock chart. With the help of 10-day and 20-day SMA, you can determine the trend in the market and decide whether you should enter or exit the market. If the 10-day SMA or the shorter SMA crosses the 20-day SMA or the longer SMA, it indicates an uptrend which signals a bullish upswing and you can buy the stock. If the shorter SMA crosses below, the longer SMA indicates a downtrend, which means you should consider selling the stock. MACD crossover. MACD crossover is a simple and efficient way of finding opportunities to swing trade stocks. Although we won't dig very deeply into this tool in this section, we will revisit it in a later section where we'll explain to you in much more detail what this involves. MACD consists of two lines, the MACD line and the signal line. You can determine when to buy or sell when these two lines cross each other. The blue line is the MACD line in the above figure, and the orange line is the signal line. When the blue line crosses above the orange line, a bullish trend is observed, and you should consider entering a buying trade. Similarly, when the blue line crosses below the yellow line, we observe a bearish trend, and you should consider exiting the trade. The MACD line swings around the zero line, which is also a helpful indicator of when you should enter or exit the trade. When the MACD line crosses above the zero line, a buy signal is generated, and when the MACD line crosses below the zero line, a sell signal is generated.